Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Market Analyst at FX Pesa.
Kindly say hi on the live comment section, and these will confirm that everything is working just fine. Awesome. So let's get started. There's quite a number of things that have been happening this week, as you all know. 3 US banks collapsed over the weekend. And at the same time, we had inflation data coming from the US. We had the UK budget earlier today. At the same time, we had ECB interest rate data come earlier in the day, where the European Central Bank hiked interest rates by 50 basis points, eventually pushing interest rates to 3.5%. So with this and more coming in the markets and a lot being expected next week, then it's very important that in this series, we go through quite a number of the events that happened this week. And once we do, then we basically get to process what to expect in the markets. So before I proceed much, I want to confirm that the voice is working just fine. And once you confirm, then we get to progress with the session. All right. So there's quite a number of things happening, and I would like to begin with the economic calendar. So as per the economic calendar this week, as you can see, I'll be going through it briefly. One, we had the adjustments of the daylight saving time, meaning that going forward, we'll be expecting a 1 hour adjustment to the US market open. So all this means is that we'll be expecting to open the market to open 1 hour late. And besides the daylight saving time, we saw the claimant count change in the UK. This is a number of people who are claiming for unemployment insurance for the first time. And in this case, we had a drop of negative 11.2K, which was very positive, indicating a resilient UK economy. So average earnings index dropped slightly to 5.7% from 6% the previous reading. And this is indicative of a labor market that is softening. And this is in line with the Bank of England expectations. So unemployment rate remained steady at 3.7%. This was also good news for the UK and also in line within the expectation of the Bank of England. So going forward, also we saw the US inflation data, which came in at 0.4% compared to the previous month of January, where it was 0.5%. So whereas this is a slight slowdown from the previous reading of 0.5%, the CPI on the year, or the rate of inflation, dropped from 6.4% to 6.0%, which was taken as very positive, especially considering the direction that the Fed is taking. So core CPI, which is basically the inflation without food and energy prices, jumped 0.5% from the previous reading of 0.4%, meaning that prices are rising higher for the rest of the commodities besides food and energy. So on the year, it was a quite slight drop to 5.5% from the previous reading of 5.6%. So there was mixed reactions in the markets, where on one side, core inflation seemed to be accelerating, whereas the overall inflation number was slightly dropping. But on the year, it was a big drop. So if you look at this number, then you'll notice that it's 9 months consecutively dropping. So while this is a good thing, the recent data from January and February seems to be an increase. And it's something that investors are worried about. So focus now shifts, especially in the US, to the ECB meeting that will be happening next week on the 22nd. So if we do a quick jump here, then you can see on the 22nd, we will be looking at the FOMC economic projections. We'll be looking at the FOMC statement, federal funds rate, as well as the FOMC press conference. So this is the most anticipated news for the month. This is when we'll be looking to understand the current Fed policy. So the Fed policy has been quite consistent over the last 1 year, where Jerome Powell has maintained a policy stance of increasingly hiking interest rates to control inflation, and the overall outcome has been a much stronger dollar and much weaker equities. However, in February, in January, we saw a change of stance as December data had indicated that the US was entering a disinflationary period. But then getting on to January, then there was a big spike in inflation as well as economic activity. Labor tightened even further, and this led to a change of stance by the Fed, basically saying that they are going to walk the path to the end. And this basically implies raising interest rates further to control the inflation that previously stood at 6.4%. So now that inflation data came in at 6.0%, we will be looking at the Fed meeting, try and understand that, the direction that the Fed will be taking, especially considering the new data concerning the stress in the banking sector. So with 3 banks collapsing within the same week, it's not good news. It's something that the market will be looking forward to understand, especially during the next ECB conference. So people need to understand the level or the magnitude of the weakness in the US banking sector. And once they understand these, then they'll be able to make the right decisions. So at the same time, people need to understand how the Fed perceives the weakness in the banking sector, whether it will get involved, whether it will account that in its decisions about raising interest rates further, because there are fears that continued hiking of interest rates would further hurt the banks and lead to a collapse of the financial system. So people will be looking to understand that on the next meeting. So fast forward, New Zealand GDP contracted to negative 0.6%. This was earlier this morning. Also an employment change, you can see that there was a big jump in February where the Australian economy created 64.6K jobs compared to an expectation of 49.7. In the previous month, it was a negative 10.9K contraction. So this was a good data. And as you can see, the overall unemployment number dropped from 3.7% to 3.5%, indicating a resilient Australian economy. So whenever the economy remains resilient, then the central bank has more room to continue hiking interest rates. So we might be expecting another rate hike this month from the Reserve Bank of Australia. So then going forward, we saw the unemployment claims coming from the US. So there was a drop to 192K from the previous reading of 212K. However, if you look at the data state by state, you can notice some outliers in the data, and these may explain the big shift from the number that we saw here at 205K, which was the expectation. So the reading of negative 192K can be explained by looking at the state-to-state data. So for instance, if you look at this tweet from Zero Hedge, it basically explains why the initial claims dropped. So if you click on this image, then you can easily visualize what was actually happening and make an informed decision. So I'm trying to enlarge the image. So as you can see, in the state of Ohio, the number of initial jobless claims was increasing. However, this is not overly big compared to the other data. Indiana was slightly slower. Illinois, Oklahoma, Florida, and the District of Columbia, all these had positive. And then the rest of the states close to zero. And then an increasingly high number of slowdown in the change in initial jobless claims. So the biggest outlier, as you can see, is the state of New York, which had a very large drop in the number of unemployment claims. So in this case, you can see that one state has the potential to influence the overall data because the number is way bigger than the other or the average of the other numbers. So in statistics, we describe these as an outlier. And sometimes when you're trying to make an independent decision about a data point, you ignore the outlier so that you can have something that is much more reasonable and consistent with the average reporting of the other states. So this is roughly about negative 15,000 jobs. So when you see a negative 15,000, it basically means that there was a big drop in New York, basically implying that there is a very high employment rate in New York. So what this means when you try to process the information is that there is an acute hot labor market in the US, and a hot labor market means that the economy is expanding faster than the number of people available to take those jobs. So whenever you see such things happening in an economy, then the expectation is that the pressure on the inflation side might increase. So whenever you're expecting a higher pressure from the inflation side, then in this case, the Fed has a mandate to respond to that information. And the expectation in this case is that the Fed goes forward by hiking interest rates as it has been doing since March last year. And another hike this time is probably ranging between 25 basis points and 50 basis points. So a 50 basis point hike would be very strong and would be very positive for the dollar, whereas on the other hand, it will be very negative for equities. However, if it comes out in line with the expectations of 25 basis points, then we could see some slight or sideways momentum in the dollar, but then equities could also take a bigger hit as a result of an increase in interest rates. So equities are looking forward to a period of time where the Fed starts cutting interest rates, or basically announces that this is the end. We are stopping the interest rate hikes now, and now we are looking forward to cutting interest rates. And that is being taken as a potential signal for the bear market bottom. So remember, the bear market started on January last year, has lasted so long. We had some instances of bullish momentum, especially in January, but the stock markets keep on weakening. So with this in mind, if we now look at the charts and we try to understand what has been happening in equities, this is the NASDAQ 100. If I zoom out, you can see the overall bear market of last year. And then this year, you can see that there has been an attempt to push prices higher. So if I was to draw a trend line here, and then I zoom here, you notice that in January, prices were very resilient and very strong, moved all the way and broke the upper trend line. February, the market was going back down. Then in March, which is this month, we started on an upper movement and then pulled back down during the crisis that happened last week. And then this week, you can see the strong recovery that is happening on this chart. So if you go to the 4-hour chart, then you'll notice even better. This was the end of last week. Remember, the crisis started on Thursday around here, and prices kept going down to this support. This week, we retested the area before the market bounced strongly and kept going higher. So this momentum upwards is basically descriptive of the expectation that prices are running higher. In this case, expecting that the Fed might go slow on interest rates or even consider taking a neutral stance. So a neutral stance would basically mean keeping the interest rates as at par or at the same level, that is 4.75%. So the bets that this could be happening are the ones fueling the bullish momentum. So hopefully, as we get into next week, I will probably be in a support or a resistance level. So my projection is that the market keeps on rising and eventually gets to this resistance level. And then we'll be making a decision from this point of whether the stock market continues the momentum upwards or eventually changes direction and moves back downwards. So a price level of 12,756 seems to be the key decision point or the most important point as per now. So once the price gets to this area, we'll be looking at whether the price breaks this area or moves back downwards. So as we progress, if you have any questions or comments, feel free to type that in the live comment section, and I'll be responding to that right away. So We are here at a grant. Thank you, Motiva. Hope I'm not late. Yes, you're not late, Kevin. Thank you for joining the session. So let's proceed. So as for equities, it's the same thing. If you look at the Dow Jones, we had this triangular movement before the market broke up, and then up before now forming this trend line, which has just been broken within the last 1 hour, indicating a very strong momentum. Sometimes it's good to remove this form of accumulated bias so that you can have a cleaner chart that gives you much more informed perspective of what's happening. So from here, you can see there is a common resistance around that 32,349. So as the price keeps on rising, I expect to see some form of resistance around this area, and perhaps the price moving back downwards or even breaking higher. So the idea is to wait for the Fed next week and see how the Fed responds to the current data. And from there, we'll have an overall forward guidance on where the Fed is looking to take interest rates. So SP 500 has already broken this resistance. So it's a similar resistance that we are seeing here and also here. So for SP 500, it has made a very strong bounce this afternoon and broken this area. So now, if we are trying to identify another key price level where the price could change direction, then it might make sense to move into higher time frames to be able to understand what has been happening. So this year, we have had a very good rally in January, February back downwards, and then in March, even down lower before getting to the price at the open of the year, which was acting as a support. But now, from this rally that we are seeing here, there is a good chance that we will be seeing the price moving further back downwards. So if you look at this high, compare with this other high, and take this as an outlier data, then you can see that the chart really connects very well with this high here. So I'm talking about a couple of data points. One is this high here. The other one is right here. And the other one on the trend line is right here, which also acted as resistance. So with these three data points, you can see that the S&P 500 is currently testing the same level. So any signs of bearish entry around this area might indicate potential trading position, trading back downwards, pricing in the information that the Fed might go ahead and hike interest rates as projected. So earlier today, we saw the ECB hiking interest rates by 50 basis points, despite Credit Suisse having a lot of challenges as well as other European banks. So for Credit Suisse, we know that it's headquartered in Switzerland, so it's not part of the Eurozone, but all in all, other European banks are having similar challenges, and we could be seeing the market reacting to that. So if the ECB was bold enough to hike interest rates when there was a lot of worry and uncertainty in banking stocks, then perhaps the Fed will also do the same, and we'll be seeing a stronger dollar and weaker equities. So Australian dollar was moving sideways last week before breaking this particular resistance, moving back to retest the area and then rallying all the way up to this particular resistance. So it's something we had marked here as the previous support turned into a resistance. So as the market was headed higher, we saw the market finding resistance again at this area, pulling back down and then going back again to this resistance before breaking back downwards. So from here, as you can see, we had a lot of data and information happening today. But one key thing, and I always try to help you understand this, is that the most recent candlesticks, and I think this is about 6 or 7 candlesticks, have had significantly lower tails, indicating a rejection of lower prices. So whenever you see something similar to this happening, every time a candlestick is attempting to go down, closes higher and leaves a long tail towards the lower side, then it's an indication that these lower prices are being rejected and buyers are entering this market. So there is a good chance we will be seeing the Australian dollar continue to rally against the US dollar and perhaps even get to 0.66952, which was acting as the resistance previously. So as for gold, we know that there is still a lot of uncertainty. We don't know the full measure of the hold that the banks are holding. And when I talk about a hold, I'm talking about the level or the number of unrealized bond losses that these commercial banks are holding. So once we get the full figure of what we're expecting, then before that, markets are reacting to this uncertainty by buying gold. So from Thursday last week, when we heard the first news of the banks collapsing, a lot of investors have been hedging their positions and buying gold. So we saw a very good rally happening before the beginning of the week. The market formed this particular flag and then broke higher yesterday. And then today, we can see the continuation as it happened. So early in the morning today, we had a session, the market snapshot series. So this was what was happening, and we speculated that the price will continue going up, which eventually happened. But now price has pulled back down and is retesting this level. And as you can see, the level was holding very well here as the resistance, and now it's now happening as a support level. So you can see there's quite an amount of war happening around this area. This is the 50-minute chart. The market is consistently attempting to break this level and fading each time. So if you happen to see a strong entry by buyers, then the idea is to go for a bullish position, targeting even higher prices. But then if there's evidence of a break, then we might be looking at even lower prices. And an idea would be to look at this level here, which is arguably the low of the last one today and some part of yesterday. So perhaps we will be seeing the market breaking and getting to test this area. So as for USD JPY, there was a quite a very strong rejection. So remember what I mentioned about candlesticks. So whenever you see something like this happening in the markets, so first candlestick, long tail indicating rejection of lower prices. Second one rejects and prints even higher. Then it's an indication of bullish momentum, a strong entry by buyers. And remember, this is happening at a key support level. So this is a support level one time, second time, and then the third time the market is extrapolating, failing to close below, and then the next candlestick prints higher. So this was a signal to go even higher. And as you can see in the last 3 hours, there has been some good momentum. So there is a chance we will be seeing the Australian dollar continue to rally, especially in correlation with the price of gold. So you can see it was a very good rally, a breakout to the lower side, a retest, and then a drop all the way down, almost 50%. And now the price is reversing. So it's in order to assume that we'll be having a continuation of the original momentum, which is arguably to the bullish side. So even on the daily, you can see how the candlestick is printing, which is clearly a pin bar here. Candlestick with a small body and a long tail towards the lower side is an indication of a pin bar, rejection of lower prices and entry by buyers. And the last 3 days were also indicating rejection of lower prices. So as for USD CAD, you can see a lot of movements have been happening. So we were on a bullish momentum here before the break. So the momentum was right here. Market broke and moved sideways for a while, and then traded in a triangle right here before breaking even higher, forming the next leg. So after forming these, traded sideways for a while, and then another leg, and kept going higher until it pulled back downwards. So from this price action, you can see that there is a pattern right here. And the pattern seems to be taking this particular path here. So it was also another consolidation attempt by the pair before the market broke towards the upper side yesterday. So after this, notice that the market broke towards the upper side, rallied all the way up, pulled back downwards, and then for today's price action is mostly sideways. So if we narrow this down to a smaller time frame, then you can see that there is some level of consistency with this price action. I would use these. Then we measure the extreme prices here. And in between, there seems to be an in-between pattern within pattern forming some form of resistance here. So this is it. And now the market is attempting to get to the lower trend line. So the decision point would be around this area here, especially if the market was to test this particular support level. So Euro USD makes bullish, I would call a rising wedge right here. I remember discussing this on the market snapshot series, and then breaking strongly down, going all the way to support. So this was some good momentum. I hope you guys captured this. Then towards the end of the day, makes a rejection. Notice the same price action pattern that I'm talking about. So market is approaching support. You start seeing long lower tails, and then a green candlestick indicating entry by buyers. Then the market rallies all the way up. So today, in the afternoon hours, This is when we had the ECB press conference and European interest rates. So at first, the euro was losing against the dollar, kept losing, and then reversed and started moving upwards. So clearly, this is a rejection of lower prices, and potentially we'll be looking at prices moving higher, and a nice target at around 1.06941. So this is a level that was acting as a resistance. So if price keeps on pushing higher, then this serves as a potential target for Euro USD traders. So New Zealand USD, you can see we are currently on a swing from the upper trend line towards the lower one. So if I zoom out, you get to see that this was a major resistance level also here. And now support is right here, and the market is on a downswing, but has not yet hit the support level. So there is a lot of noise in between. So there is always patterns within patterns. So in this case, for our 15 minutes chart, we know that the traders are monitoring this particular resistance here. And also from the lower side, you can see there's some form of support in this area. So it looks like a descending triangle. So if there's a good chance that the market breaks here, then it might present a potential opportunity to trade downwards, especially if such a break happens here. So the opportunity is to go all the way down and get to a price level of around 0.61305. So as for pound USD, similar case, market rallies all the way up where the pound was strengthening against the dollar, trades sideways for like 2 days, and then breaks back downwards and then moves back to retest the area. So this was a key resistance point, 1.21357, and the market seems to be headed there. Try and retest the same area again. So as a trader, I would be monitoring the price action around this area to see if there's a retest of this area and the market keeps going down, or if the market gets back to pattern and continues in that direction. So 1.21357 remains a key decision point. So for my favorite this year has always been the FTSE 100 or the UK 100 index. So clearly it was strongly bullish. So if I use a higher time frame first, just to give you some perspective, you can see the large number of swings that were happening between the two green trend lines. So eventually the market managed to break the upper one and kept going up, pulled back, and then rallied all the way to an all-time high before the fast sell-off that happened here. And this was within a very small number of days that the price kept on dropping. So within 5 days, we had all this sharp drop. And of course, markets are not always unidirectional. So whenever there's a sharp drop, we expect some form of pullback. And I think this is what is happening today. So after the sharp sell-off here, the market traded sideways for a while. But now you can see there were rejections of lower prices, and the market is attempting to move higher. So the idea is to move to a smaller time frame, in this case, the 50 minutes chart, and then observe the price action here. If there's a break higher, then you trade a reversal. If there's a rejection of that resistance, then we basically trade the continuation, and the continuation is the overall bearish momentum that we have seen on the daily chart. So the idea is always to try and follow the trend. So if the trend is strongly downwards, then these pullbacks always represent an opportunity to continue trading along that particular direction. So in this case, as the market keeps on retesting here, if there was a sign of a rejection of higher prices, then I would definitely go for a short selling position. So I am talking about something similar to this. So price gets to the trend line, goes up, and then fails to break and moves back and closes here, indicating a sign for a short selling position. Market attempts to go the first time, second time, and eventually drops towards the lower trend line. So something similar could be bring up here. So you just have to be vigilant, observe the price action, and then make a decision if something happens along that line. So I'm still checking to see if there's any comments or questions. So besides that, there's more that is happening in the markets. One, there's a very nice thread here on Twitter from James Slavish, basically describing what is being experienced in the US right now and the new realities that investors are getting to process minute by minute. So let's go through it quickly, just to give you an idea of what's happening in the US economy. So if you've never heard of a debt spiral, it's time you did and ask the question, is the US already in one? So a debt spiral is where, let's say you think of it individually, where you take on some debt in order to fund your budget, which eventually increases your consumption and your income is not at the same level. So on your next check or on your next income, you find that the money is not sufficient to pay your bills and continue paying your existing debt. So as a result, you borrow even some more money in order to continue funding your crucial bills and at the same time repay your old debt. And that becomes a spiral where you keep on borrowing higher and higher until you can't borrow no more, eventually getting into a financial crisis. So if you think of the US government as a business, you know it has income or revenue that it collects from the people in form of taxes, and then there's amount that it gets to spend in form of a budget. So any business, like any other business, a government has revenues and expenses and often borrows money using debt. So 95% of US revenues come from taxes, and this is both individual and corporate income, as well as payroll and excise taxes. So 5% of the revenue just comes from estate taxes, customs, Fed earnings, penalties, and other fees. So I'm trying to fast forward this. So if a government is operating in a deficit, it can either cut expenses and cutting expenses is not good. Politically, it's not good. So if a government is cutting expenses, it's similar with what is happening in Kenya. Our president basically mentioned he's cutting government expenditure by 300 billion. And a lot of people are suffering, and you can see that the opposition is getting stronger and it's getting very political. So you lose votes and you lose the positives that you get when you are being supported by the people. So the government doesn't want to cut expenses at any given time. So the other way to get out of the debt spiral is by generating more income. So generating more income, if it's an individual, if you generate more income, then you cover more bills and you're able to pay your interest rates comfortably. So the way a government can generate more income is by stimulating the economy to produce even more so that they can tax more and get more income. So by stimulating the GDP, we normally see it happening in a number of ways. One, we can see the government engaging in a war, like we saw Trump doing. We had the China-US war. In this case, it was a trade war where Trump was looking to get access to the Chinese market for US companies to sell more products and limit the amount of products that were coming from China, which would basically give the US government more revenue. So it can also be a physical war, and in some other cases, it might be simply printing more money, stimulating key industries, making sure that they are operating at full scale, like we saw happening during the COVID period. And in that case, the government was collecting more taxes. So the last one and the most painful is raising taxes. So yes, President Biden's budget is looking to raise more taxes to tax the higher income earners in order to get the US government collecting more revenue. So this is not very popular. Governments don't like raising taxes because it becomes hectic, especially with the strengthening of the opposition. So going forward, the problem of cutting expenses costs votes. War can lead to future productivity damage, and higher taxes can impact companies' ability to grow, and in turn hurt the economy's GDP, leading to lower tax revenues. So the easiest thing to do, just issue more debt to cover the budget. So this doesn't solve the problem. We all know what happens to a company that issues too much debt and winds up unable to pay the interest on it. So it becomes distressed, and it cannot fix its budget problem. It eventually goes bankrupt. So for governments, they don't go bankrupt because they have the ability to print more money. So whenever they have a debt spiral, they keep printing more money. And the result of this is higher inflation because you have a wider monetary base that is chasing after fewer goods. So whenever that happens, then you get to see inflation. So in this case, we are looking at a similar situation. So if the banks in the US are breaking as a result of the high interest rates, if the Fed stops hiking interest rates and considers cutting interest rates, allowing more money to flow within the US economy, then this would be very positive for equities, but the currency will suffer from high inflation since the monetary base will be much higher. So we have seen reports this afternoon saying that the emergency credit line that was created by the Fed earlier this week to support the ailing banks could print up to $2 trillion. So if such were to happen, the dollar would weaken extremely low, and at the same time, equities will enjoy the free money and would be seeing stocks selling. So this may explain why we are seeing the stocks make some good comeback today, but the buck stops on Friday, on next week, when we see the Fed FOMC press conference and they clarify a way forward for the US monetary policy. So as for now, it makes sense to trade within limits, within the limits of basic technical analysis and understanding the major swings in the market, but the fundamental direction will most probably come from the Fed. So that's it for today. Thank you very much, everyone. Going forward, that is tomorrow, we'll be expecting a couple of news from the markets. So from the economic calendar, I just want to do a brief highlight of what we're expecting tomorrow. So all these are low impact news, save for European inflation data, which comes up at 1 p.m. on Friday. So in the previous reading, it was 8.6%. We expect this to slow down slightly to 8.5%. So a big jump from this expectation would cause volatility in European pairs. This also includes European equity indices, such as the Euro stocks. Also, the German DAX could become volatile as a result of the CPI data. And then as we approach the end of the week, we'll be looking at the preliminary UOM consumer sentiment in the US, as well as the inflation expectations at 5 p.m. Then on Monday, we'll be having our market snapshot series. Remember, this happens at 11 a.m. Nothing much will be happening on Monday. So I expect traders to be depending on technical analysis to make decisions unless there will be more news happening in the markets. So sometimes it's not just the economic calendar. Sometimes it could be, let's say, the banking crisis, new developments, new policies happening over the weekend. So you have to be very, very vigilant, follow the fundamentals to understand what's happening in the markets. So Tuesday, this is our big day, Canadian CPI, Canadian trim CPI, core CPI, all these happening at the same day. Then a speech from ECB President Christine Lagarde, existing home sales for the US, before we get to UK CPI. So next week will be pretty much locked. We get CPI from Canada. Then on Wednesday, CPI from the UK, and then the FOMC press conference, as well as the statement and interest rate data for the US, before we look at the SNB. So the SNB extended a pretty big credit line for the Swiss bank, that is a credit source. So we will be looking at the monetary policy statement and how SNB is going to respond to this. So I expect the Swiss franc to get very volatile on Thursday next week. Then we look at the interest rates from the UK on Thursday. So a lot of action will be happening next week. Towards the end of the week, we'll be looking at the flash manufacturing and services data. And this will be coming from the Eurozone, also from the UK, retail sales from Canada and the UK. And then towards the end of the day, or in the end of the week, we will look at our flash manufacturing PMI, as well as our flash services PMI. So a good question, do we scalp and trade in between lines or after breakouts from the scalping lines? We test and execute trades. I don't understand which is the best between or after. So I consider the extreme price levels to be the premium entry and exit points. So if, for instance, you are referring to the one I did here for the UK 100, that's as the FTSE, then I consider looking for a trade around this area based on the price action of these candlesticks. So rejections like these tend to give the best opportunities. Also rejections like these tend to give the best opportunities. So I want to trade along this line based on what I see from the candlesticks. I hope that answers your question. So I know there's one asset that I've not mentioned. So this is Brent oil. which has been largely and extremely bearish. Besides myself having a very strong bullish outlook for oil this year, the prices have consistently shown that they are going further downwards. So we have seen a very strong sell-off this week in oil. And if you follow this particular trend line, then you can see that the price action from yesterday was an overextension, or when we say that the price is oversold. So after this point, you can see the market made a very strong comeback, traded sideways, and then today attempted to go back to retest the same level. And then there was a very strong rejection and the market bounced pretty strongly. So I expect the price to resume and keep pushing even higher. So on the short run, I expect some further momentum upwards, maybe to 76.675. And if we break that, then even higher, getting back to $79.47 per barrel. So there is a good chance we'll be seeing some further recovery in oil, especially after the big sell-off. When there was fear in the market, now people are getting more clarity and understanding the gravity of the situation. So that's it for today. See you on the next session on Monday, and this will be at 11 a.m. during the Market Snapshot series.